All right, well, good afternoon, everybody, and welcome to the September 7th, 2021 post-Labor Day edition of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula and Kim Butcher. Say hello, guys.
Hello, everybody. Glad to be here.
Hi, everybody.
And as far as I know, the weather's behaving in Florida. It's okay here, but we do have sporadic thunderstorms. Did Ida get all the way through the area down there, Kim?
Ida was on we just got a little bit of rain. It was nothing compared to what everybody else got. Absolutely nothing here.
Well, we're converting to it's a little warm today, but we are approaching autumnal conditions. And it's that time of year when Ken and Natalie like to drive around and look at colored leaves.
It's one of my favorite times of the year, Mark.
So that is coming. In fact, Sleeping Bear kind of brings that to mind there. But today I thought what we would cover is just a few things. There's a good article on Gary Gensler at the SEC in this weekend's Barron, so we thought we'd just capture some highlights. He actually covered the payment for order flow issue that we tossed around briefly, and I brought a little bit of clarity to that. Our friend the bear, still hibernating, but he can wake up at any time. So we want to talk about that a little bit. Ken and I want to make everybody aware that in early to mid-November, we will be putting on another series of conference webcasts, so we'll talk about that. That happens to be a wonderful waterfall. I'm sure you're familiar with it, Ken.
That's Tequamanon, right?
Yeah, it is. Just a little bit north of Mackinac Island and a little bit west. It's up there in God's country, even farther north of Traverse City in Michigan. And it's probably one of the most beautiful waterfalls I've ever seen.
Yeah, and that color right there is indicative that this is a third week September, maybe fourth week September picture. You don't have to wait until October to get the color going on in the Upper Peninsula.
Yeah, because that's up in the area that gets about 150 inches of snow in the wintertime.
Yeah, that's just par for the course.
And of course, it is time for us to release the rabbits. That's in honor of the red rabbit there, that we will be talking about our annual hunt for the best small companies. So that's part of today's program too. So let's go ahead and get underway. Standard disclaimer, many familiar names on the list. Welcome back. If you're relatively new here, we do try to keep these informal. You can communicate with us by raising your hand if you have microphone and audio equipment, or you can enter a question or a text into the questions tab. Everything that we do here is about education and demonstration, with emphasis on the demonstration. We are here to share the lessons, legendary lessons of the modern investment club movement, that being how to identify and discover an excellent company and how to figure out if it's on sale or not, and whether or not it fits in your portfolio. So we attempt to basically explore that together, and share our opinions about some of the best techniques, again, demonstrated over the better part of 8 decades now. Please do your own homework for anything that is mentioned in real time. Again, no investment recommendation whatsoever is intended. We will attempt to remember to remind you anytime that we own a particular stock that we're talking about. We do have a monthly program called the Round Table. It's on the final Tuesday of every month, 8:30 Eastern time, running a little over 11 years, and with an annualized rate of return of about 19% for the tracking portfolio. Kim, did you have a thought?
No, you just kind of broke up here, and I didn't hear anything, so I wondered if we'd lost you.
I think, am I still here okay with you, Ken?
Yep, you're coming through. There was a little bit of activity in the forest there for just a moment, Mark.
Okay, well, we'll take what we can get. We're probably wrestling for broadband capacity with Chrysler. We have a shared office here in this home. If you have questions, or if you'd like copies of the slides, if you have future suggestions for other topics, please send me an email at markr@manifestinvesting.com. All right, let's keep pressing on here. Here is our bullpen, or the queue of topics that have been recommended and stuff that we're going to tackle today. Today we want to continue that discussion on historical market barometers and quality allocation. We are going to talk about releasing the Small Company Hounds. Got a pretty good track record over the last 10 years with the best small companies, and that effort gets officially underway every year after Labor Day, and that is today. Hope everybody had a great holiday weekend. I know we did. Just a quick comment on the payment for order flow, but you can see some other topics that we will be coming back to. Ken and I were just talking about the inflation one before we came online here today, and a couple other ones that have come up. Do want to at least kick around and consider the topic of special dividends. It's something that you don't see quite as much as we used to in the past, but there are a couple companies that came out with fairly robust special dividends, and might give some time to think about that. Any thoughts or comments, Ken or Kim?
I really like our queue here, Mark. It's you read down that, and we could put together a couple hours on almost any one of these topics. So keep on giving us the ideas, folks, and we'll keep on trying to put together some coherent conversation about whatever it is you're interested in.
Yeah, and the only thing I want to say is I'm going to double check, Mark, and I'll let you guys know that I know with the book Layered Money, there was another book coming out, and I think it was coming out this month.
Okay. Yeah, and I'm pretty sure crypto is misbehaving today, but it's had quite a run for the last month or so, and it's an interesting area. Ties in a little bit with the Gensler stuff we'll talk about in a minute. All right. We'll start with a slightly busy slide. This is one that's kind of a personal favorite, but one that we don't feature very often at Manifest Investing, but it's kind of one of my backup slides for, again, trying to get a feel for the overall environment of investing and what I might think. As many of you have heard me talk about in the past, there have been times when this actually kept me in the market, especially with my parents' accounts, which I helped with a little bit, that type of stuff, just by simply noticing the fact that stocks were continuing to go up. And even though you hear a lot of people talking about bubbles, you hear about Kathy Wood talking about this is not a bubble. In fact, it might be just the opposite. I don't know who's right, but there are a whole variety of opinions. But right now, notice that we are going through a period where the market continues to soar, and we continue to see a number of stocks setting all-time new highs. What you're looking at on the graphics is just simply the new highs minus the new lows. I believe this is for the stocks that are listed on the New York Stock Exchanges. And you can see that obviously it fluctuates like anything else in investing. We keep track of, how big the green or grayish bars are, or these areas are, versus the red or pink or magenta, I guess that is, below, when more stocks are falling than rising. And the thing that we have talked about a number of times in the past is this period back here, called the Great Recession. There wasn't much great about it, but this was a pretty tough period in time. And equally rough to that worst time in stock market history was this moment from a year ago, which really was kind of a flash in the pan and very unusual and just weird. And the recoil or reflection back from that was sudden and completely different from other moments in stock market history. I mean, here's another small one here. But this particular indicator, if you want to dig into it, again, I'm bolstered by the fact that this blue moving average line, that's the trailing 12 months smoothed out. This blue line is basically near all-time high. So if you follow the words down at the bottom of the slide, this is a presentation. You can actually go to the Manifest Forum and look at this discussion between Barry and the author and creator of this index or indicator in the Manifest Forum. But one of the things that he covered in the session was this notion of, bear markets don't start when companies are continuing to set new highs. Basically, the market peaks out, and the leaves start falling off the trees, and you basically see a bunch of companies not setting new highs anymore. And the author of this indicator actually goes through a discussion with a bunch of students and professional investors where he walks them through, and you can actually read that at that forum post. But where you really want to start to become concerned is when the new highs stop, and you basically get this trailing off situation. And as Barry says, analogous to the leaves falling in New England. Now, Ken, I thought that the leaves might, warm your heart here.
Thank you, Mark. Appreciate it.
But
that was one giant leaf right there. That's all that was.
So it's an interesting indicator, and again, it has helped me a few times in the past when everybody was basically saying run for the hills, and unless I see the type of activity that we saw going back into the tough days of 2008, and again, unless I was preserving capital, I wouldn't even really care about that. But again, most of those are pretty quick bounce backs. So again, just one more way to measure the environment or the sentiment. And the message that I hear when I look at this is get back out there and shop for excellent companies at good prices. I hope that doesn't. I went with my message. It's almost like the soundtrack for The Good Witch. If
You don't know what kind of
I only watch it till I can't stand the music and I have to leave the room. All right, here we go. Groundhog update. This is just a public service. Again, the dashboards track most of them. We do need to update a couple of stock splits, but pretty interesting results. Ken, you're still up there. Kim and I are still represented by number 15. A number of Ken's clubs are on the leaderboard this year. So Ken, take a cyber bow and continue to hope for the best between now and February.
Got a long way to go yet, Mark. Okay.
And you're so superstitious you won't even talk about this. All right. Well,
He's smart. He's smart, Mark.
We do jinx ourselves from time to time, don't we? So anyhow, we are not having the best year as a collective group. We knocked it out of the park last year and had a couple of really good years. The average return in the stock market is almost 18%. The average for participating groundhogs right now is actually up to 8.7%, but only 26% of the participants are beating the market right now. And that heavy hogs that you see there at plus 10.8%, that has beaten the Wilshire 5000 every year that we've had this contest. And it's now 7 percentage points behind at this point. That's the consensus selections of the community, tracked in a single portfolio called the Heavy Hogs. And just as we warned you, Kathy Wood seems to be picking up some steam. She is up to 130th. She was down in the bottom 2 or 3 positions for quite a while and seems to be picking up some steam. Any other thoughts on this, Ken?
Well, not really, except to say that there's considerable movement around these top 38 places here, except for the top 3 or 4. I'm noticing Herb Lemko, for example, moves between the 30s and the low teens on a pretty regular basis. So he must have a fairly volatile portfolio that he's chosen. A couple other ones in there that really move up and down that list too.
Yeah, I think he's got NVIDIA in there for one that's been turbulent. Yeah. And I'd be remiss if I didn't highlight the fact that it's quite a few ladies up at the top of that chart, along with our good friend in New York, Nick D. Virgilio. And he's crossing his fingers and hoping for the best also, but a lot of competition there from the ladies. All right, that's so much for our public service announcement. Just wanted to take a moment, and because we had kicked around this payment for order flow situation, which has been in the press a little bit over the last few weeks. And what it amounts to is it is the business model at places like Robinhood. Why do I say that? Because, again, I'm not going to read the slide to you, but these are some of the highlights from the discussion. A lot of brokerage firms, including Schwab and many of the others, Fidelity, not so sure about Vanguard, but a lot of them get what's called payment for order flow. And in the case of Robinhood, it accounts for a vast majority of their revenues. So companies that actually engage in this, including one of our best small company picks this year, Virtu and Citadel, they actually depend on this whole notion of bundling up or consolidating a bunch of transactions and selling them off market, if that's the way you want to think of it. And Gary Gensler, the relatively new chairman of the SEC, is looking into this. And I guess maybe I've been asleep at the wheel, Ken, but I was kind of stunned to hear that as much as 50% of the order flow out there now is happening off market at these so-called dark pools. Maybe we talk about them a little bit more in the future. I know I had read a book a few years back on the dark pools, but it doesn't seem right to me that so much of our activity could be happening off the market. And Gensler is talking about it, thinking about it.
What really draws me up short from reading these snippets from this article, Mark, are the fact that retail investing had fallen to low double digits. It's back up now, it says 22%, but it had fallen to, it's looking like 11 or 12%. I did not realize that it had gone that shallow as far as the retail investor was concerned.
Yeah, and I think some of the high frequency stuff skewed that a little bit for a while. Yeah, it's just been a different landscape. We did an entire session on this a couple years ago where we talked about it at one point back in the formative days of the modern investment club movement. As much as 70 or 80% of the transaction volume came from the retail investors. And that's completely flipped on its head over the last several years. And we dedicated an entire presentation to what that may portend for all of us, and certainly the influences it has on our studies, etc. But yeah, it is a very pervasive thing, and they're talking about is a fairly extreme position of banning it. It is banned in a couple of countries, like Sean Mace pointed out last week. But the one thing that kind of jumped off the slide for me was this final comment down here. One of the things that I have noticed, although it's not something that is really obvious or even something that you think about all that much, is these credit default swaps from the turbulence of 2008 and 2009, which were just monstrously a problem. And Gensler, whatever he did in this role, has at least removed it from our daily discussions. I hope it's not because we're ignoring. I hope it's because this notion of taking them into a more visible and more regulated situation, that's actually a pretty good outcome. If you go back and actually study how incredibly nasty these credit default swaps. I'll never forget the phone call from Hugh. Hugh was in Switzerland, and he calls up and asks me if I've ever heard of these things, and then described how much of a threat they were to irreparably damage capital markets back in that 2008 timeframe. So I'm kind of glad to see that somebody's thinking through this stuff, and hopefully we'll come up with a consistent approach. I don't think payment for order flow is really something that bothers us on a daily basis, and I don't think it compromises our stuff all that often. Probably impacts the traders more than investors. Would that be your take on it, Ken? Or
I absolutely. I don't notice a couple cents, and that's usually what that payment is, a couple cents per share when you make an order. But I don't notice the difference in price of 2 cents up or 2 cents down when I make a long-term buy. Mark, Shirley would like you to expand just a little bit with a definition of dark pool, and if you're having a hard time doing that, she wonders if we can bring that back up at a future session and talk about what they actually are.
Well, we can do both. We can come back and define it and actually share the book from Scott at the Wall Street Journal and some of the highlights from that book. But a dark pool is simply something that happens off exchange. So what is referred to as a dark pool would literally be clearing entities or agencies operating without actually reporting the transactions across the exchanges. That's my understanding, that it's basically a form of private market transactions where in many cases they'll bundle up or consolidate up a bunch of retail trades and then do a private market transaction between two owners that happen to own the stock. So it's conducted in a way that is not reflected. You know, in theory, if you place the last trade of the day on a particular stock, that would be the price, whatever price you agreed with the buyer or the seller, would be the price that showed up in the newspaper. Remember how we used to look up stock prices in the newspaper? So in theory, you could actually be that number at the end of the day. With a dark pool, it would never be part of that equation.
Are these trades regulated in any way, shape, or form, Mark?
I don't think so. I think I really don't know. I don't know to what extent they are monitored or that I don't know. That's something perhaps we can dig into a little bit deeper. You know, what is the extent of regulation on them? Okay, let's go ahead and press on. Hopefully that gives a little bit more clarity as to who's doing it, how big it is, and you know, why it's something we might think about. I don't know how disruptive it is to the overall picture, but
Mark, Len is letting us know that while Schwab only makes a little, you know, a fairly small amount of money doing this price to order flow, TD Ameritrade, which is now owned by Schwab, makes over $1 billion a year on its price to order flow arrangements. He found that Fidelity and Merrill Edge don't do price for order flow, and that brokerages do have to report all that on a form called the 606, which means that that information is available, albeit you have to dig for it a little bit sometimes.
okay. All right, let's go ahead and talk about the hibernating bear. Still seems to be hibernating, but that can change suddenly and without warning. And we had talked about this one a little bit, so let's just dig into it a little bit deeper. We talked about this average investor equity allocation indicator, which you see right here being the best according to some research done that goes back over 50 years by Mark Hulbert, the guy in the picture there. Mark Hulbert, who ranks people who write about investing, newsletters, that type of stuff, and he's worked for Forbes and CBS Market Watch and the Wall Street Journal, etc. So he's been out there for years, and we've enjoyed some of the conversations we've had over the years. He attends a number of conferences and that type of stuff, but he's ranked these various indicators from most effective. And again, predictive value is simply a comparison between what was predicted versus what actually materialized. And his findings over the years is that this average investor equity allocation, which Ken and I think might be a little bit of a misnomer, but it's okay. We'll explain. But ranking 8 different indicators, notice that the PE ratio is down here, and that's kind of triggering to Ken and myself. But as we have discussed, we are talking about the PE ratio of the S&P 500, which we have often pointed out. I'm not sure that is a very valid number in any case. What are your thoughts on this, Ken?
Well, it's a collective number, and it's made up of the total earnings from a given year of the S&P stocks, you know, and the price of those stocks. Just add it all together. It's a typical PE value, but I don't know what it means if you tell me that the S&P has a typical PE of 21. That doesn't even mean that companies have an average PE of 21 within that group. All it means is that the price of one share of each stock in the S&P 500 added together divided by the earnings of all 500 of those companies added together works out to be 21. And that 21 is just a number I pulled from my head, guys. That's not the actual value. But I don't have any use for the number once you tell me what it is. It might be interesting if it's rising over a long period of time. It might be interesting if it's falling over a long period of time. But especially with these indexes right now, controlled by a half dozen or maybe a dozen names, it becomes less and less relevant to me, I think, as I try to work my way through what's a good PE for a particular stock that I'm looking for.
Mm-hmm. Yeah, and the price to sales ratio is kind of made famous by O'Shaughnessy and Ken Fisher, and it's one that's got a little bit higher efficacy, if we can use that word. And again, that's a fairly straightforward calculation that's a little more immune from some of the gymnastics. I would argue that price to book ratio is just vulnerable to a whole bunch of tax impact, engineering, and ramifications, and it's just a mess when you start getting into the calculation itself. Dividend yields are simply today's dividend yield is not your grandfather's dividend yield, and it's so dramatically different that thing is that's just a wreck. I don't know what Q ratio is. We'll come back and define that. I actually don't know what it is. The CAPE ratio is the Shiller CAPE ratio, which is just simply the PE stuff, but smooth or average over a trailing 10 years. And then last but not least, the Buffett ratio, which is actually pretty comparable to this one, comparing the total market cap of all stocks to the gross domestic product. And these are the reason we're talking about this is all of these indicators are flashing incredibly bearish right now. Run for the hills bearish. And I don't know. Would it be too cold for me to say I don't care, Ken?
Well,
maybe that's a little too unfeeling.
Yeah, I don't want to say I don't care about where these indicators are pointing, because sometimes when a macro indicator points in a certain direction, that does trickle down to the individual things that make up the macro, whatever it is. But I want to stay focused in my own mind on the fact that I'm not buying the S&P 500. I deliberately stay away from index investing because if you're going to ask me to buy 500 stocks and make a profit, I think maybe it's a little bit of ego, but I think I can maybe do better by picking only 3 or 4 or 5 or 10 of those 500 and making a better profit. So I'm not investing in a market that an index measures. I'm investing in individual companies, and frankly, not too many of them. I still, even with all the investing that I do, I like to keep my portfolios to 16 plus or minus 4, 12 to 20 stocks. If they have different audiences, then those stocks may or may not overlap, but grand total of stocks that my wife and I own in 3 substantial portfolios is probably under 30. So I just don't see the value of a lot of these predictors on a very regular basis, at least.
Okay, let's go ahead and press on. I mean, I agree. I mean, many of the professionals, many financial planners would tell us that what we do is impossible, and they're entitled to believe that. I just ask that they sit back and watch us do it.
Well, I thought, Mark, that you sitting around the campfire and talking to some of the persons you were talking to might have been some of those rhinos.
You're absolutely right.
And are they still not believing it?
Pretty much.
You know what? Then all we can say is cha-ching, and we'll do it our way.
Yeah, at some point there, you just can't help some people. All right.
Our audience is great, Mark, because all you have to do is say you don't know something, and somebody in our audience is going to give you the answer. George Mackey says that the Q ratio is the market value divided by the replacement cost of the company's assets.
Oh, that Q ratio.
There you go. All right.
Just like Trivial Pursuit. Once you tell me, I know it.
I was going to say that.
Okay.
I was going to say I read it a long time ago, but didn't remember either.
That actually makes a lot of sense. That also, I would expect that to do better, in the mix. All right, I'm inspired by that comment that we invest in companies, not markets. To just revisit a moment from the past, this is a cover story, an open letter to the president that it still ranks as the most heavily trafficked email and comment thread that we've had at Manifest Investing, even though it was 13 years ago. It did go to both President Obama and candidate McCain, because the criticism was basically directed at both of their, at least the attitudes they were presenting while on the stump campaigning. And you can go back and read the article, but my whole point was that the way that the federal government, in many cases, they do so many things right, but one of the things that they do tend to come up a little bit short on, at least in the opinion of people who have followed the modern investment club movement, is this notion of, taking care of investing and that kind of stuff. So I basically urge them to get a better handle on it and perhaps spend some time with their local National Association of Investors chapter, that sort of thing. But it all comes down to this. If you go back to that time frame, and using Tin Cup as just one example, Tin Cup is a model portfolio that we've been running since January 1995, as you see here, and it had peaked out at a value of almost 800,000 back around Halloween 2007, which, by the way, is the beginning of the disruptive turbulence back during the Great Recession. And over the period between that and up to the time of the election in 2008, had a fairly substantial fluctuation from the peak value down, and basically made the point that, people were saying run for the hills and, oh my gosh, the world is coming to an end. Wouldn't we be better served, being in 2% guaranteed return vehicles? All those type of thoughts. Nobody at the barbershop or in the hair salon was talking about stocks at this time, and we know better. This is where the long-term perspective matters. It matters the most, and this is an example of one of those times when you want to be out there with Ken's 16 plus or minus 4 best companies possible to weather these type of storms. Did you have any thoughts on this, Ken, or should we just keep rolling?
Well, I think that when you open up this graph to the present time, you make your point. So flip the page and make the point, Mark.
So here's the point. In the black box is that period of disruption covered by that letter to the ultimate president, and just, urging a better understanding of long-term perspectives in investing in general. Again, we don't buy markets. We buy really cool, excellent companies over the long term. And when you get in moments like we saw in 2008 or even in March 2020, the best advice we can possibly offer, and we're offering it now, go out there and find the deepest of the deep blue chips. And as we branch this into the hunt for the best small companies for 2022, we're going to stick to that for them also. So I just think this slide makes such a point when you talk about, do you abandon ship and run for the hills? 10 years after this moment in time, I can remember sitting in a room full of teachers who had gone to cash in their individual retirement accounts, or actually in their 403Bs, and coming back and sitting down with them, out here, and they were still in cash. And that just hurts. I mean, that just practically crushes my heart to see that happen. And so much of it is because we have this notion of being able to jump in and out of stocks and markets and that type of stuff. Any other thoughts on this, Ken?
I don't know what to say, Mark, except that we run a family club, and in 2008, the beneficiaries of the family club were 9 years old, 7 years old, and 7 years old. 2 7-year-olds and a 9-year-old, and we couldn't have afforded even a half a semester of college for those 3 kids with the family club in 2008. It's 2021, and we have graduations coming up in less than a year now, and we've managed to fully fund college educations for 3 kids now, all the way through to senior year and one of them to junior year. And it is all due to this graph, to the way that the picture comes out, and it's all due to those 16 plus or minus 4 stocks that the Kabula Family Investment Club holds and invests in the kids for tomorrow.
I don't think we need to say any more than that. It's just buy the best companies, find them. This entire discussion was based on this chart, which you can actually access at the website up at the top. Just search on that, philosophical econ. But what it basically points out is that there are periods in time when things get overheated and the interest in stocks peaks, and we're in one of those now. And this chart actually stops at 2013, and we'll show the current day version of that. And it's just further proof of the time when everybody is enthusiastic. We're not saying that it's necessarily a bubble. I'm saying I'm not sure it matters. No matter what this type of information points to, in my case, I think it points to just get out there and buy even higher quality stocks and remain as fully invested as prudent to do so for your personal situation. Here's the update. Again, this is from an article on MarketWatch by Mark Holbert. And what you're looking at here from left to right, again, going back over 50 years, the left y-axis is the allocation, and it's inverted. So the more feverish the interest is in stocks, the lower that red line will get. And that's the point that Holbert is making with this slide, that back around the turn of the century, back around the year 2000, and again, we are talking about the S&P 500. I'm sure Ken's going to hammer that home here in a minute. We're basically back at that level. And in fact, the report that will come out here in a few days with the update will probably take this below 50, somewhere down into here. So the right y-axis is the projected return over the subsequent 10 years. So if you think back to the year 2000 and basically the lost decade, which was 10 years of the stock market going nowhere, if you're measuring the stock market by the S&P 500. And all this is basically saying to me is that we might be back either near or at a moment like that currently. Your thoughts, Ken?
Well, I'm heartened, Mark, that these low points on the green chart seem to bounce after one data point. They don't seem to go down and stay down in the negative range forever. So even that point, and I'm sure that one you have circled is the IT bubble, the .com bubble.
Mm-hmm.
But it hit low and then it bounces, and once it bounced, it kept on a moving. The same way that it bounced in 2009. We can see the bounce, but it's at a pretty high level up there. It's not at a below zero level. So sometimes you have to live through a little bit of adversity. when you're looking at the macro. And all I know is that we've shown you graphs and we've done anecdotes and we've done every thing we can to point out that high quality stocks don't move with the market as far down as the market moves, and high quality stocks tend to recover faster, and high quality stocks tend to move up higher than the market tends to move, with exceptions, of course. But we're looking at specific stocks that we own, and that's been my experience over 35 years now, that if I just stay true to my principles, I'm going to do all right.
Yeah, and I guess one other thing jumps off the page at me, and then we'll see if Kim has anything. But Ken, we were talking about the 1970s and inflation a few minutes ago. In that box, you're basically looking at a period of time when the investing public became the most disinterested in stocks over that time frame, and company fundamentals probably kept going pretty well during that time frame. Notice that some of the best returns in the market, came basically as a result of this disinterest. So if we get into one of those moments of extended disinterest in the market, and I think we've just been through one. It's just a reminder that keep your head down and buy excellent companies at a good price, and chances are the rewards are achievable.
Yeah, the only change that I would make on the whole slide, Mark, is I might cross off the word household. I think it's misleading, and I think the slide that follows this one is going to help explain why I think that's misleading.
Yeah, let's go ahead and switch to that just to make sure that the definition is there for people that want to dig a little bit deeper. And yeah, this kind of clears up some of the stuff we talked about last week. And the word here, Ken already used it, is macro. It really is macro. It's looking at total market value of all stocks and basically comparing that to total amount invested in equities versus basically debt, total liabilities. And again, we're looking at a period in time where this number is projected to peak out on the right-hand side. All right. Anything else we want to add to that?
It's interesting, Mark. It's interesting and true still only 70% of the time.
That's right. All right, so let's talk about October being the worst month to invest, because that's what Mark Twain said. Mark Twain was wrong. It hurts me to say that. I grew up on the Mississippi River too, so he's one of my heroes. But September can be a tough month for investors, so we should never be surprised by that. And we pointed this out about 20 years ago, so I thought maybe it was time for an update. We talked about this Saturday morning a little bit, and we'll cover it a little bit in the newsletter. But here are the returns updated to reflect the last 20 years. And again, just makes the point that September can be kind of rough. We used to have this thing called the January effect, and we're going to talk about that a little bit, where you basically would buy small companies come December and prosper from a little bit of a boost. But there are no small companies in the S&P 500, so that aspect of the January effect is a bit flawed looking at it here. But the comparison that was inspired by Sean is, well, let's just talk about the last 20 years, because investing has changed a little bit. And notice this change. Has the January effect completely changed? And at least from this one snippet of information, it might suggest that September is a great time to put your head down and go shopping, especially if stock prices begin to drop a little bit. And with the knowledge that at least historically and even over the last 20 years, that the next 5 out of the next 6 months have a pretty nice looking picture. I guess it's 4 out of the next 6 or 7 now. Your thoughts?
Yeah, the other date that sticks out to me, Mark, is Groundhog's Day. That might be a great day to stick your head in the sand and wish for spring to come, and at the same time invest in more stocks. I mean, March and April do pretty well.
Well, again, it warms my heart, Ken. It just raises the probability that you and I will end up in Punxsutawney someday. You never know. When this pandemic stuff subsides, it's got to be on our short list. A bucket list for Ken and Mark's travels.
A to-do list, not a bucket list.
Okay, a to-do list. All right. So let's talk a little bit about application here. There's our friend the red rabbit, our symbol for small company stocks. I think this one's a little more accurate and fun. A lot of fun. A lot of red rabbits. Here is the current status of this year's list. Again, we pick them on Halloween. We watch them for the next 12 months, and then we log them in. We have a really good track record, which Ken has forbidden me from talking about in any great detail. I had to wrestle with him to be allowed to disclose this status report because he's afraid of jinxing ourselves. But we're actually about 5 percentage points ahead of the Wilshire 5000 year to date, best small company year to date since last Halloween. And I'll make 1 point and then just get out of the way. 2 points. There's a lot of banks on here. Second point, though, is that, this gain in one of those banks, and we see this all the time, this gain in this one position basically absorbs all of this. It basically offsets all of that. Not quite, but pretty close. And then you're left with the whole rest of it as a remainder. And we've seen that year in and year out with the best small companies, that some of those just misbehave badly. I mean, this was probably my favorite stock in the whole group a year ago, and it just hasn't worked out very well. AutoHome is a Chinese autotrader.com, so that kind of explains that one. But what are your thoughts, Ken?
I think the two decisions that we made last September in preparation for presenting this list, decision number one was to begin to seriously look at asset-based companies, and that brought the banks and insurance companies into contention for addition to the list. And then decision number two, I know AutoHome made it through, but if you remember, we probably scrubbed 4 or 5 Chinese companies from this list, just feeling that we didn't have enough reliable information about them to base a decision on. Mm-hmm. So I think doing those two things really pushed this list to beat the standard that we've set for ourselves.
And Kim, I think, go ahead, Kim. I was going to just tip my hat in your direction with biotelemetry and a couple of those other themes if you want to take those home for us.
Well, I just want to tip my hat to myself because at least I have 2 of them on there I have brought to the round table. And I'm kind of like, I'll grab any straw I can get. And, as we talk to everyone and we say, where do we find our stocks? A lot of times it's the same place, the value line or just searching for stocks. But I still love how I found biotelemetry by having a flight and coming down to see the parents, and the guy sitting next to me was a salesman, and I found out he was a salesman for biotelemetry. Yep. So I always ask, are you flying for business or pleasure? And when I heard business, then I started asking questions.
Field research at 35,000 feet. Excellent.
Cha-ching, I'm not complaining.
All right, so last but not least, our last slide for today. This is the preliminary, very preliminary, I underlined it, for this year's list. And it's just an example of the type of companies that we will be in the traditional mode challenging as this list takes shape over the next 8 weeks or so. So if you find a good small company and can bring it, especially if it's one that we don't cover, but it seems to be attractive, and I'll let Ken underscore this, but we are dead set on companies that are not only on sale, but of high quality, even though they are small. And we're pretty much dead set on that. And I'll just close with, some of those up at the top have been featured quite a bit here recently, so we're pretty much in tune. Green Tree is, however, a Chinese lodging company, so we may have to have some special discussions about that one. But anything grab you at this point, Ken?
Well, I like Matt Spielman's Green Brick Partners. I really like MHO, that's MI Homes. I really like LGIH Homes. I don't think that their runs are over, and I think the folks that are predicting the end of the housing market are a little bit premature in that whole realm of predicting and looking at their crystal balls and everything. And I also like the fact, Mark, that there's a dozen or more companies on this list of 20 that I don't know anything about, which means that I'm going to have some things to search and to study and to come up with either arguments why they belong on the list or why they don't belong on the list. So it's a great list for a preliminary. I only want to end with the thing that I think that I probably mentioned to you sometime during the first time we sat across the table from each other when we first met down up in Saginaw at the country club. When I said, you can buy small companies, you just have to ask of those small companies the same things you ask of your big companies. Demand excellence, demand quality. And it didn't take long to convince you that was a pretty valid statement.
Yeah, that and your hot stock tip on Neogen at the time. All right. I forget it. Afraid I even said that. No, it's very much true. And in fact, on this list, I was very pleased to see Sharp's compliance. If you're not familiar with the company, it's a good study. It's one that actually emerged out of Kim's work with Tulane and the professor down there in the student investment club or the endowment that they actually run. But that's a pretty good study, and I really like seeing companies like that. I do own a small stake in Sharps, so I've come to know the company a little bit. Not a very big stake yet, but that is the type of company that can make a considerable difference in the results year to year. And of course, we probably won't end up with all of these regional banks. Just the fact that they continue to appear means that they can't possibly fall off our radar screen completely. This one looks interesting too up here at the top. So dig in a little bit deeper and see what's going on.
We have an interesting question from Cheryl. She says, who makes the decision on when to sell any of these companies? And Cheryl, this is a 1 year let the list stand kind of a demonstration. And once we print this list on November 1st, that'll be our list for 2022. And we'll put up with whatever we put up with. We're not going to try to change out or anything along those lines. The only time that a stock will disappear from the list is if it goes bankrupt or is bought up by some other company. And I think Mark explained that in 2021, we did have 2 stocks that actually were bought up by somebody else. Both of them, or one of them with some profit involved. I'm not sure exactly whether there was any profit involved with Global Cord or not, Mark, was there?
It's just a weird Asian markets transaction. There's been a private equity firm out there trying to buy up the shares of Global Cord for quite some time, and it's kind of tangled. The one thing that I would note about Cheryl's question, though, is again, hindsight being 2020, I wonder if we had the rule of 5 in place here for an actively managed portfolio, if we might not have taken action on a 20% drop below the market on some of these and basically protected ourselves. I'm just going to leave it at I don't know. We might experiment with a conceptually only type situation in the future, but no, we buy them and hold them from Halloween to Halloween in the demonstration portfolio.
Okay, and then Len is making the point that SIMO, SIMO, is a Chinese company, but it's Taiwan Chinese, not mainland Chinese.
Right.
So that might be something that you'd want to keep in mind.
Okay. All right. So again, we'll close down with our reminder that all of these sessions are archived on YouTube under Manifest Investing, and you can grab them there. And Ken, I'll let you go ahead and talk about this one a little bit.
Well, folks, by now, most of you know that the Better Investing National Convention, which was supposed to be held near the end of October, has been postponed again because of COVID. It was going to be in Dallas, and Dallas is a hotspot right now. So we're asking you to save some dates on November 10th and November 11th. That's a Wednesday and a Thursday. We'll be running some classes. And on Thursday evening, we'll be running a stock panel with, we hope, some really good ideas to share with some of the best stock pickers in our community. The registration materials will probably come out sometime near the very end of September or the beginning of October, but there'll be plenty of time for you to register. We'll remind you, and we'll give you lots of different ways to register so that if you can't do it one way, you'll be able to do it another way. We'll get it up on our website. We'll have it on Manifest Investing. We'll mail it out to our mailing list that Mid-Michigan uses for the roundtable. So we hope to attract a nice audience. Our stock panel already has Cy Lynch and Mark and myself and a number of other folks that Ann Cuniaz will be on the stock panel for the first time in our COVID cancellation conferences. And we're hoping to attract 2 or 3 other folks yet. So save the date, November 10th and 11th. We'll have 3 pretty interesting classes, we think, plus the stock panel. And we're starting right now to solicit questions for one of our classes. The title of that class will be 20 Questions for Investors. And we'd like to solicit good, solid questions that have bothered you for a while as a moderately experienced or experienced investor. Send those questions to Mark or to myself. And we probably won't have time to answer all of them, but we're going to try to fit 20 or more into our session. And it'll be Cy Lynch and Mark and myself coming up with answers to those questions. And what's nice is if we get the questions ahead of time, we'll be actually able to research when we don't know the full extent of our answer, and we'll be able to give a real nice complete answer to those questions. So if you have questions, send them to Mark, send them to me, and we're going to start collecting those in the next 6 weeks or so and hope to put together a very interesting session. Mark, back to you.
Yeah, we do have some experience with answering 20-ish questions in that type of a time frame. Clubbing American style we did last year is a pretty good model for that, and that's kind of what we hope to do. So again, anything pressing that you'd like to see a little bit deeper dive into, let us know. So with that, I'll just leave us with an autumnal picture of a park somewhere, and wish everybody a wonderful September. We'll see you again next week. Ken, I think if everything's...
I know you don't normally think of forests when you think of Charleston, South Carolina, but boy, does this look like the park on the Battery in Charleston. Looks just exactly like it with the same kind of benches and everything.
All we need is a little Spanish moss, and that would bring it home.
There you go. There you go.
Somebody can send us that picture for a future session. All right, so with that, I'm going to go ahead and close down. Thanks, everybody. See you next time.